Welcome back. Now it's time for our weekly energy update with Dan McTeague, President at Canadians for Affordable Energy. All yours, Dan.
Thank you very much, Teresa. And of course, we are very much into the few weeks before Christmas. And of course, we do not see any major movements in gas prices or, for that matter, energy prices, even though temperatures have been dropping across North America. And even with OPEC now deciding to discipline itself and to maintain its production cuts the next 3 months, it doesn't seem to be phasing the markets. Understand that the markets no longer obey the laws of economic fundamentals. Supply and demand has been thrown out the window in favor of, folks who do day trading, hedgers, money managers, big positions taken by folks who tend to ignore the most important signals. A little bit like trying to cross a railway track and ignoring the fact that gates are coming down, the red lights. Well, that's what the market is doing right now. Whoever is directing it, it's very large corporations, BlackRocks, and there's many others that are out there that have been around for quite some time. They're doing their very best to mitigate and to ignore and to find excuses. And they've been doing this for a better part of a year. The problem comes in the next year or so, excuse me, when we see that prices are going to have to reflect fundamentals sooner or later. And I think it's going to be a lot sooner. 2025 should see a rebound. I noticed that one of the largest producers of oil in the United States, Chevron, has said they're cutting back 10% of production in their Permian Basin, which of course is, we consider Eagle Ford and Nabera and many others that they have, West Texas. Those are areas that have been very important in terms of the United States being able to produce a lot of oil and of course export some of that while they import a lot from Canada and will continue to do so. The danger is that, we may be seeing the twilight of a lot of these plays in the United States where the shale revolution may be coming to an end. That'll be disappointing news for the Trump administration, which, came in on the old moniker, drill, baby, drill. But the reality is that we're going to start to see upward pressure on prices one way or another. For us here in Canada, for the foreseeable week, I'm not seeing much activity. Even though the Canadian dollar continues to show significant weakness, unemployment numbers are down, which means the Bank of Canada is probably going to have to reduce interest rates a full half point, as they did a couple of months ago. And that could mean, of course, an even greater weakening of the Canadian dollar. So it doesn't look like after Christmas we're going to get much of a break. We know the federal government and their friends in the NDP never gave us a break on GST, on fuel prices, on heating prices. Back many years ago when I did the rebates in 2001, again in 2003, they were directed at using funds that we had. The federal government had a surplus of GST as prices had gone up. We remitted a lot of that to Canadians, particularly for home heating. Now what that means is right across the country, although we have seen a bit of an increase of 3 or 4 cents a liter in some instances and a drop of 2 cents a liter in Atlantic Canada, there's going to continue to be upward pressure on the price if for no other reason, the weakness in the Canadian dollar. And so, Teresa, what we're looking at is a scenario playing out between now and Christmas where prices are likely to go up a little bit, and they're going to go up a lot more as reality starts to set into a market that's been very willing to ignore the elephant in the room, and that is, of course, dwindling supply, increased demand. These prices has gone up a little bit, and of course, it doesn't matter if there's more people or less people driving electric vehicles. Those vehicles have to be made with diesel to mine their products. They have to be produced with, styrenes, with polymers, resins, plastics, and of course, tires that are made of rubber, which are, of course, made of of oil. All these mean that you're simply transferring and displacing oil consumption from one type to another and giving the illusion that somehow this is going to drop consumption. It's not. And the foreseeable future is going to see an increase in demand as we head towards 105 million barrels used every day across the world, when in fact we can only supply about 104 million barrels. So that shortfall is going to continue to show up. And what that means is that for the next week, I would predict gas prices up about 2 cents a liter starting on Wednesday or Thursday. Nothing this weekend as markets continue to ignore fundamentals and what's happened with OPEC, which is pretty significant. So all of this really means, for the first week of December, things are remaining relatively quiet, but they won't remain this quiet forever. Colder weather will force up diesel prices, which in turn forces up gasoline prices. And we'll talk more about it this time next week, Teresa.